This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 8, 2026, and this is the After Hours session. Now, let's get into it. Fear is at 14 out of 100. The VIX is suppressing at 15.57, and we are standing in the shadow of U.S. strikes on Iranian missile sites near the Strait of Hormuz. The dollar is surging, gold is rallying, and the carry trade is shaking violently. Let's look at the data. Turning our eyes to the schedule, the primary catalyst for the next 24 hours is the Reserve Bank of New Zealand's rate decision on Thursday, July 9th. This landing coincides with a wave of U.S. weekly jobless claims, also falling on Thursday. For the New Zealand and Australian dollars, the RBNZ decision is the focal point of volatility. For the U.S. dollar, the labor data serves as a barometer for whether the Fed's restrictive stance at 3.63% remains necessary. There are no other major individual corporate earnings driving FX flows in this window, though the broader market watches NVIDIA's valuation relative to peers as a gauge for tech sector risk appetite. Here is the snapshot as of July 8, 1913 Eastern Time. The Fear and Greed Index is deep in fearful territory at 14 out of 100. The VIX is holding at 15.57, down 0.24 points. Gold is trading at 4123.03, up 0.59%. The U.S. dollar index sees leveraged funds adding to bullish positions with a net plus 4,438 contracts. Meanwhile, the Japanese yen is drowning in shorts at minus 115,400 contracts. Let's dig into the news moving these numbers. The dominant headline comes from Forex Live. U.S. strikes Iran missile sites near Hormuz as ceasefire lapses. Additionally, reports confirm explosions heard in Iran, and reports coming in that the U.S. military is conducting strikes against Iran once again. Oil has reacted instantly, jumping 7% as Trump threatens bigger Iran strikes and targets Karg Island. How does this headline translate to your books?
It translates to a false sense of security. You are looking at a VIX of 15.57 and seeing calm. I am looking at a Fear and Greed Index of 14 out of 100 and seeing a market that believes this conflict is contained. That disconnect is where the liquidity dries up. The VIX is not pricing in the Strait of Hormuz risk because equities are still trading on lagging data, but FX spreads are widening. If the VIX fails to break above its 5-day high of 17.75, it means the market is ignoring the tail risk. That is not stability, that is a trap.
And that trap is funded by leverage. Look at the yen shorts. Minus 115,400 contracts is not just bearish positioning. It is a structural liability for any broker or fund holding those shorts. As long as the headline risk is geopolitical tension, the dollar buys. But if that headline flips to a confirmed blockade of the Strait of Hormuz, that minus 115,400 block becomes a fire sale. The market isn't pricing in the strike. It's pricing in the continuation of the status quo. Once the status quo breaks, the unwind isn't linear, it's vertical.
CIPHER identifies the fragility, but Pulse sets the foundation for why the dollar absorbs this shock without breaking. The market is treating the US dollar as the only clean vehicle in a dirty room. We aren't just seeing a war premium. We are seeing a flight to quality driven by the fact that core PCE is stuck at 3.41%. The Fed has nowhere to hide behind. So when the bombs fall in Iran, capital doesn't flee to barns. It flees to the cash balance sheet. The DXY net plus 4,438 contracts confirm that institutional allocators are front-running the yield differential. Knowing that with CPI at 4.17%, rate cuts are off the table regardless of the geopolitical noise.
So the macro narrative is clear. Sticky inflation meets geopolitical shock, supporting the dollar. Let's pivot to the technical structure of the primary beneficiaries, starting with dollar-yen. It is trading at 162.367, essentially flat on the day, sitting just cents away from its 5-day high of 162.4625.
Technically, this is a squeeze. 162.367 is practically touching the ceiling of 162.4625. In a normal environment, this would be exhaustion. In this environment, it is compression. The price action is refusing to break below the midpoint of the 5-day range, which started at 160.4835. We are seeing a classic range-bound consolidation where the bid side is absorbing every dip. The 162 handle is acting as a magnet, and right now the sellers are stepping aside to let the buyers test the high again. There is no reversal signal here, there is only the absence of selling pressure.
Don't mistake the absence of selling pressure for organic demand. Remember that minus 115,400 contract short position. What you are seeing as technical support at 162 is actually a line in the sand for leveraged funds. They are sitting on a knife edge. If dollar-yen touches 162.4625 and rejects hard, it doesn't mean the uptrend is over. It means the margin calls begin. The flow data shows these shorts are maintained not because they think Japan is economically strong, but because they believe the geopolitical status quo holds. Break that belief, and that technical level dissolves instantly. You are watching a technical chart superimposed over a speculative bubble.
And SPECTER warns that the bubble is inflated by the very silence CIPHER describes. The VIX is at 15.57. Why is the equity market so quiet while the FX market is bracing for a regime shift? Because the options market is pricing in continuity. But when you have a fear and greed index at 14 out of 100, the only direction left is down for risk assets. If dollar-yen breaks 162.4625 on high volume, it won't be a gentle slide to 160. It will be a gap down. The liquidity at 162 is thin compared to the order book depth required to absorb a coordinated short covering event. Be careful mistaking a pause for a peak.
Shifting gears to the safe haven. Gold is at 4123.03, up 0.59%. It is holding firmly above the psychological 4,100 mark and well above the 5-day low of 4,092.40.
The structure here is pristine. Look at the 5-day range, 4,092.40 to 4,203.23. Gold has tested the lower bound repeatedly and found absolute refusal to break. 4,092.40 is now a hard floor. More importantly, notice the distance from the current price of 4,123.3 to the 5-day high of 4,203.23. We are in the middle upper quartile of the range, but the momentum is skewed upward. The candles are closing near their highs. This indicates accumulation. The technical setup suggests that 4,100 is not just support, it is the new baseline for fair value. Any dip back toward 4,092.4 will likely be met with algorithmic buy orders.
That technical baseline is reinforced by the real yield reality. With the 10-year 2-year spread flattened to just plus 0.35 percentage points, the opportunity cost of holding gold is negligible compared to holding short-term treasuries. Furthermore, with core PCE at 3.41%, the erosion of purchasing power is the primary driver, not just war fear. The technical floor grid sites is actually a macroeconomic floor. As long as inflation remains above the 2% target, the nominal price of gold has a structural bid. The chart shows where the price is. The inflation data explains why it refuses to leave.
But look at who is buying. Leveraged funds are pouring into the dollar, not necessarily spot gold, though gold follows. The net plus 4,438 contracts on the DXY suggest that smart money is using the dollar as the primary hedge. Gold is the secondary hedge. The concern here is that if the geopolitical situation stabilizes even slightly, the flow into gold could reverse faster than the flow into dollar. The positioning in gold is strong, but it is reactive. The positioning in the dollar is proactive. Watch the cross-currents. If the DXY strengthens beyond 162.5 in dollar-yen, gold might face temporary profit-taking despite the macro backdrop.
Let's look at the casualties of this risk-off environment. Aussie dollar is trading at 0.693815, up 0.23%. It is trapped inside a tight 5-day range of 0.69107 to 0.69604.
We are seeing a contraction pattern here. The range is narrowing. 0.6938 is roughly in the middle, but the wicks on the hourly charts are getting shorter. This is indecision. However, note the relationship to the RBNZ decision on Thursday. Typically, we see expansion before a central bank event. Currently, we are seeing compression. Technically, the 0.69107 level is the critical support. If that breaks, we drop to the mid-range support at 0.6900. But right now, the bulls are defending the 0.693 level. It is a coin flip, technically speaking, leaning slightly bullish because the selling volume appears exhausted.
Exhausted or exhausted because the longs are too scared to sell? Look at the COT data. Plus 31,777 net long contracts on the Aussie. That is a massive exposure. The week-over-week change of minus 7,334 tells us someone is already exiting. Who? Smart money. The fact that the price hasn't crashed yet is because the shorts are equally terrified of shorting a currency that is tied to Chinese stimulus hopes and iron ore demand. But the positioning is unsustainable. Plus 31,000 contracts is a lot of skin in the game for a risk-off environment. If the RBNZ language is anything less than dovish enough to justify this leverage, that long side gets liquidated.
And SPECTER highlights the timing risk. You have a crowded long position in a low volatility environment. The VIX is at 15.57, meaning implied volatility is cheap. Traders are likely not hedging these Aussie longs with puts. They are hoping for the best. When the RBNZ announcement hits on Thursday, if there is any ambiguity, the unhedged longs will rush for the exit simultaneously. That creates a liquidity vacuum. Aussie dollar doesn't need to break 0.69107 to suffer. It needs to simply fail to hold 0.69504, triggering stop losses clustered just above the current price. The danger isn't the breakdown, it's the speed of the unwinding.
Finally, let's touch on euro dollar. It is trading at 1.1413, up 0.10%, hovering near the lower end of its 5-day range of 1.13984 to 1.14623.
1.1413 is probing the 1.13984 support. It hasn't broken it yet, but it is testing it. The chart shows a series of lower highs since opening the session. The structure is weak. The 50-period moving average on the 4-hour chart is sloping downward, and price is trading beneath it. Unless we see a decisive close back above 1.1440, the bias is bearish. The support at 1.13984 is being tested by fading buyers. If that level gives way, the next logical technical stop is 1.1380.
That technical weakness is a direct reflection of policy divergence. The Fed is holding at 3.63% with stubborn inflation. The ECB is facing a softer European economy. The spread between U.S. yields and German bonds is widening. The dovish ECB vs. hawkish Fed dynamic is mechanically pushing euro-dollar down. The technical support at 1.13984 is being undermined by the fundamental reality that U.S. rates offer a better risk-adjusted return right now. The chart is showing you the result of that monetary imbalance.
And look at the flows. Asset managers are net long euro at plus 255,158 contracts. That is a huge structural long book. Unlike the leveraged funds chasing the dollar, these are long-term holders. They are not reacting to the daily geopolitical news. This creates a counterforce. When euro-dollar dips toward 1.13984, you will see large, patient buy orders absorbing the panic. The difference between euro and Aussie is that euro has deeper, more stable institutional backing. The Aussie longs are speculative, the euro longs are strategic. That makes the 1.13984 level much harder to break convincingly.
We've covered the majors. Let's synthesize the week ahead.
Here is the unified view. We have a market caught between a war premium and a carry trade unwind. Pulse established that the Fed's hawkish constraints at 3.63% prevent any dollar weakness. Grid confirmed that dollar-yen is technically compressed at 162.46, ready to snap, while gold has a firm floor at 4,092. CIPHER revealed that the yen shorts of minus 115,000 contracts are the most dangerous lever in the system, capable of accelerating dollar strength exponentially if the geopolitical headline worsens. SPECTER warned that the low VIX of 15.57 is masking the fragility of these positions. The strategy is simple: respect the dollar strength, respect the gold floor, and treat RC and yen as liabilities that will unravel rapidly. The RBNZ decision on Thursday is the spark, but the gun is already cocked.
Key takeaways. First, the dollar is structurally supported by sticky inflation and geopolitical safe haven flows, with dollar-yen testing key technical resistance at 162.46. Second, gold holds 4,092 as a hard support level, backed by core inflation data at 3.41%. Third, the crowded yen short position of minus 115K contracts poses a significant risk of a violent unwind if the geopolitical narrative shifts. Tomorrow, watch the RBNZ decision for Aussie/Kiwi volatility and monitor the VIX for any breakout above 17.75 that would confirm the end of equity complacency. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.